You know that feeling. You buy one stock, it goes up. You feel like a genius. You check your phone every 5 minutes. It's exciting. It's addictive. It's also statistically the fastest way to destroy your wealth. You hear stories about people who got rich on one stock: Tesla, Apple, Nvidia. Those stories are real. But here's what they don't tell you. For every one person who got rich on a single stock, thousands lost everything. The math is brutal. The data is clear. And once you see the numbers, you'll never look at your portfolio the same way again. Chapter 1: The 14% Problem. Let me start with the most important number in this entire video: 14%. Over a recent 10-year period, the S&P 500 was up an average of 15.2% per year. That is a fantastic return. But here is what most people do not realize. Of all the stocks that were in the S&P over that period, only 14% of them produced better returns than 15.2%. 86% of stocks underperformed the index. More than half of stocks actually had negative total returns over that period. How is that possible? How can the index go up so much when most stocks are losers? The answer is skewness. Stock returns are not evenly distributed. A small number of massive winners carry the entire market. The best performing stock over that period was Nvidia. It was up a total of 22,842%. That is not a typo. 22,000%. That one stock alone pulled the average up dramatically. If you did not own Nvidia, you missed a massive chunk of the market's return. But here is the problem. You cannot predict which stock will be the next Nvidia. No one can. Even professional money managers, with all their resources, cannot consistently pick winners. According to Spiva, only 14% of US actively managed funds have outperformed the S&P 500 over the last 10 years. The data is clear. Most stocks underperform, most funds underperform, but people keep buying individual stocks because they think they can beat the odds. The odds are not in your favor. Chapter 2. The long-term numbers get worse. The 10-year numbers are bad. The long-term numbers are even worse. Antipetagisto analyzed about 3,000 US stocks from 1926 to 2022. His findings are terrifying. The median 10-year return on a single stock lags the market by 7.9%. Let me say that again. The median stock underperforms the market by almost 8% over 10 years. Not a few stocks. The median stock. Half of all stocks do even worse than that. And it gets worse for stocks that have already done well. For stocks that were among the top 20% performers over the previous 5 years, the median 10-year market-adjusted return fell to negative 17.8%. Since World War II, that has been true 93% of the time. 93%. That means if you buy a stock that has already had a great run, you have a 93% chance of underperforming the market over the next 10 years. Here is why. Great past performance usually results in high valuations. A company that has grown dramatically is priced for perfection. Any disappointment, any slowdown, any new competitor, and the stock gets crushed. Hendrik Bessembinder did a separate study covering all US stocks from 1926 to 2019. He found that just 4% of stocks produced all of the market's excess return over Treasury bills. The other 96% of stocks just matched risk-free bills. The top 86 performing stocks, less than 1/3 of the total, collectively accounted for more than half of all wealth creation. If you did not own those 86 stocks, you missed half the market's gains. The odds of picking a winning stock are not 50-50. They are far worse. Chapter 3. The Volatility Drag. Here is the hidden cost of owning individual stocks. It is called volatility drag, and it destroys returns. Let me explain with simple math. A stock that goes up 50% one year and down 50% the next year has an average return of 0%. But what is the actual return on your investment? You lose 25%. $100 becomes $150, then $75. You are down $25. The arithmetic average is 0%, but your money is gone. This is the volatility drag. It is also called a volatility tax or variance drain. The more volatile a stock, the larger the drag. Individual stocks are extremely volatile. The average stock has an annualized standard deviation of 45%. A diversified portfolio of 100 stocks has a standard deviation of about 16%. That difference matters a lot. Bernstein research shows that during the 20 years ending 2003, the volatility of the average single stock cost almost 3 percentage points of return per year versus the S&P 500. Nearly 2/3 of average stocks underperformed the market. And for the highest volatility stocks, the compounding rate was only half the market's. Why does this matter? Because volatility drag compounds over time. A stock that is up and down every year will have a much lower geometric return than a stable portfolio with the same average return. Diversification mutes volatility, and lower volatility leads to higher compounded returns over time. Most people do not understand this. They see a stock that has been up and down and think the average return is what they earned. It is not. The volatility tax has already been taken. Chapter 4. The concentration risk. Here is where this gets personal. Most people with concentrated stock positions did not buy the stock on a whim. They worked at the company. They got stock options. They got restricted stock units. They worked there for 20 years, and the stock went up. That is how wealth is built. But it is also how wealth is destroyed. Clay Cooper, a wealth management advisor at Northwestern Mutual, points out that people with concentrated positions tend to have a lot of emotion behind them. They feel good about the stock because it has done well for them, or they work there and are rooting for the company. But emotion is not a strategy, and the data on concentrated positions is terrifying. Petagisto found that concentrated portfolios of greater than about 10% significantly increased portfolio volatility. He assumed market volatility of 15%. The concentrated position made it much higher. Here is the real problem. If you have 50% or more of your net worth in one stock, and that stock drops 50%, you have lost 25% of your total net worth overnight. If the stock goes to zero, you have lost half your life savings. And it happens more often than you think. Bernstein research looked at 10 companies that corporate executives and analysts identified as America's best. Over the period from 2000 to 2002, 7 of those 10 lost at least half their stock value. Lucent lost 98%, Cisco lost 86%, Intel lost 79%. These were not small companies. These were the titans of American business. And they got crushed. The market is constantly innovating. The top 10 stocks in 1990 were not the top 10 in 2000. They were not the top 10 in 2010. By 2026, 0 of the top 10 from 1990 were still there. Innovation is disruptive. Companies that seem invincible today can be gone tomorrow. Chapter 5. The tax trap and the solution. Now, let me talk about the excuse that keeps people trapped in concentrated positions: taxes. I have heard this 1,000 times. I cannot sell because I will have to pay capital gains tax. It sounds reasonable, but it is a trap. Clay Cooper at Northwestern Mutual says a big mistake he sees is people letting the tax tail wag the investment dog. They make tax decisions on investment decisions. He had clients who did not want to sell their stocks in 2 big publicly traded companies because they did not want to pay capital gains tax. Both of those companies are now down about 50% from their all-time highs. The capital gains tax would have been a lot cheaper than what the market cost them in losses. This is the tax trap. You hold a stock because you do not want to pay tax. The stock drops. You lose more than you would have paid in tax. You held for the wrong reason. AQR Capital Management has studied this problem extensively. They call it a 3-for-1 solution, the ability to de-risk a concentrated stock into a diversified portfolio, the addition of active returns, and potential ongoing tax benefits after the transition is complete. Long, short, tax-aware factor strategies can be particularly useful here. These strategies can generate net capital losses that offset the gains from selling the concentrated stock. But you do not need to be a hedge fund to fix this. You can simply start selling your concentrated position gradually. Use the 0% capital gains bracket if you are in it. Sell enough each year to stay under the threshold. Spread the sales over multiple years. No single stock is worth your retirement. Not the company you gave 30 years to, not the stock that made you rich. Diversification is not a strategy to make you rich quickly. It is a strategy to make sure you stay rich. Concentration builds wealth. Diversification preserves it. Here is your to-do list. 3 steps. Do them this week. Step 1. Check your single stock exposure. If one stock is more than 10% of your net worth, you have a concentration problem. Start selling. Step 2. Understand the math. Only 14% of stocks beat the market. Your odds of picking a winner are not good. Diversification is not about giving up returns. It is about increasing your odds of success. Step 3. Talk to a fiduciary advisor, not a salesperson, a fiduciary. They can help you transition out of a concentrated position in a tax-efficient way. You worked too hard to build your wealth. Do not let a single stock take it away.